I'm Bri Lynch, head of market insight at EquityZen, and I'm joined here today by Phil Haslett, our chief strategy officer. And we're really excited to dig into two of the trends that we've seen evolve as the private markets continues to evolve. And those are specifically evergreen funds and SPVs. For those who are new to the space, to kind of set the framework for why this is something that we're seeing a lot more of now, it's really because some of the biggest growth stories in tech are happening now before the IPO instead of 20 years ago when a lot of that growth was happening later. When you look at companies like Stripe, Anduril, OpenAI, they're staying private much longer, achieving in more cases these centacorn, so $100 billion valuations within the private markets before any public market investor could even, have access to participate in that growth. This is coming at a time when there are half as many public companies as there are private companies. So the investable universe for public market investors is also shrinking. So, really setting the landscape for the growth in the private markets. Private markets are nothing new to most institutions. They've been playing in this space for a while, but it's been a more recent trend that individual investors are more actively participating in this market. And that's really led to the rise of these structures that we're going to talk about. So excited to dive in. Phil, to kind of kick things off though, why is the old structure, the old way of the private markets failing these new individual investors? And how have you seen that market evolve over your time with EquityZen?
Well, I think it's a good opportunity to give a history lesson, which is that in 97, Amazon went public at something like a $450 to $500 million valuation, which meant that if you were an investor and you had even exposure to the S&P 500 over time or the NASDAQ, you had exposure to Amazon's incredible growth to the point where now it's a $1 trillion plus company. If you fast forward now, we're looking at companies that are still private when they're worth $500 billion or more. And the reason for that is because these companies are able to raise capital in the private markets from mostly institutional investors. They can kind of have their cake and eat it too, right? They can raise capital. There isn't as much responsibility or onus and cost involved with being a private company versus a public one. And that stands to benefit the company and how it operates. But unfortunately, we found that retail investors are a little bit left out of the story, which is honestly kind of why we started EquityZen and why we're starting to see the proliferation of other investment offerings that we feel like can finally bring some of these private company opportunities to retail investors.
Absolutely. So the market has really changed through EquityZens, through some of these products we'll talk about, where you don't need to have $10 million to commit to a private equity fund for 10, 15 years to be able to participate. Let's start by diving into evergreen funds. We've seen this mass upcoming of a lot of these semi-liquid structures, really with the goal of enabling broader investor access to the private markets. So unlike traditional funds that close after a few years, you could think of your typical private equity fund that maybe raises and then closes, and then you hold those investments till there's an exit. These allow perpetual access for individual investors, and they've really exploded recently. We've seen that private wealth-focused evergreen funds have hit over $350 billion in AUM. Some analysts are saying this number is going to cross over $1 trillion in the next 3 years. So talking about massive amounts of capital, and with interval funds specifically, the assets in those funds have doubled in the past 3 years. So, really massive markets that are enabling non-accredited investors to access some of the hottest names that we talk about in the private markets. Some of the big players in the space that you may have heard of, you've got Robinhood Ventures, Arc Venture Fund, Destiny XYZ, all offering access to some of these fast-growing companies like OpenAI, like Ramp. So can you talk about these structures a little bit more and what an investor in these funds is actually investing in?
Yeah, absolutely. So I think first it's worth pointing out that this investment structure, this kind of capital market solution was addressing a problem, which is that financial advisors and individual clients wanted to invest in alts, right? We've steered away from a traditional 60-40 portfolio of public stocks and bonds. And so those advisors and their clients want exposure to alternative assets. The problem before was that the structure to invest in an alternative asset was typically a privately held fund, didn't have much liquidity mechanism, it had capital calls, and it had trouble at scale, right? When you had people writing $100,000 checks or $250,000 checks, the old model broke. And so, as a solution, we've seen the advent of in popularity an evergreen fund because it allows an investor to kind of come in at various times. It has some liquidity mechanism, not perfect. I'm sure we'll talk about that, but it has some liquidity mechanism. And I think importantly for a financial advisor, for a client, it doesn't have these ongoing capital calls, right? Like you put money in, you get a tax document at the end of the year, you take money out. And that's something that investors are used to. So I think it solved a big critical problem on kind of how investors got access to the thing they wanted, which is alternative assets. And then within alternative assets, you can think of the private markets and pre-IPO technology companies as one sleeve, right? In addition to things like private credit, et cetera, et cetera.
As you've explained, these products have offered easier access and democratization, so you don't have to be an accredited investor or qualified purchaser to participate in a lot of this growth. So that's really exciting. Obviously, as at EquityZen, we love the story of democratization within the private markets, but I think it's important to note that this democratization does come with fine print, and the public markets and the private market operate very differently. So what may be marketed as a liquid or semi-liquid fund is holding private assets. And, that's going to change the actual liquidity and what that means for investors in these funds. So can you talk a little bit about what happens when the fund's net asset value doesn't match the price at which the fund is actually trading? Because again, these are exchange traded funds. They move with supply and demand. And what are some of the case studies of this we've seen, and how should investors think about that when they're considering these funds as an access point?
Yeah, so I don't think there's been a perfect solve of a product for investors to get exposure to the private markets through public funds. And part of that is it makes a lot of sense. When the underlying assets you hold are quite illiquid, right? And people want to buy and people want to sell, that fund is going to need to either adjust what it holds to meet the needs, or it might use a different structure like an ETF, and then sometimes the valuation can get distorted. So maybe we'll give two examples. So there are some pre-IPO funds that are structured as ETFs. So that means money comes in, money comes out. You can sell when you want to. The problem is to keep up with the demand, you might not have enough assets in the fund. So we've seen some of these ETFs trade at as far as 10 times the net asset value of the fund, which is completely ludicrous, right? It's kind of like if you said, "Oh, I like Nvidia. It's valued at 4 trillion, but it's hard to access it and a bunch of people want it, so all of a sudden it's worth 40 trillion." Like you wouldn't do that, or you wouldn't pay 10x. But that's actually what's happening with some of these funds. The other types of funds that we've seen that are pretty common are interval funds. And so back to your point, Bri, the devil is really in the details. These funds are advertised as having liquidity available, but really what they have is a redemption right for a percentage of what you hold. So you may put in $10,000 and you own $10,000 of this fund, and every quarter you might have the ability to sell up to 5% of what you hold. Selling $500 out of 10,000 is very different than selling your entire position, right? And so that is something that investors really need to take in consideration. The reason why they're structured that way is back to the fact that the underlying holdings of these funds are relatively illiquid. So a manager needs to keep cash, or they need to keep some investments that are very liquid to match up with the liquidity needs and redemption rights that investors have. And we've seen how this can kind of go south. The private credit world is dealing with the same conundrum, which is there were private credit funds that were structured as interval funds. So investors put in, they've expected they had liquidity needs. And what's happened is that as investors have decided they no longer want exposure to that asset class because maybe it's underperforming, they look to sell and they look to try to redeem. And if you have more than 5% of the fund that's all trying to redeem, you actually kind of get this logjam of liquidity needs, right? And so sometimes managers will go so far as pausing redemptions. So all of a sudden, the liquidity that you were promised is no longer available because they are overwhelmed with the needs of redemptions from their underlying investors. So I think it's a really good point to flag that even though these investments are kind of pointed out to as having liquidity and being a great solve for getting exposure, no one's really found the perfect version of these offerings, which is why you're starting to see maybe the advent of things like special purpose vehicles, et cetera.
And you can kind of think of, we mentioned earlier, private markets, public markets, very different. To enable this access, in some ways, you're kind of trying to jam a square peg into a round hole and make something fit where there's not a perfect match of features between these different types of structures. So definitely something to look out for, the fine print that investors should look into. And then I think in terms of just general portfolio allocation, when you are investing into one of these semi-liquid funds, knowing that they aren't fully liquid, think about the right buckets of capital that make sense. So you shouldn't be investing money that you're going to need in the near term, maybe not even the medium term. This should be longer term capital that you're looking to grow, similar to how we would suggest that you invest in really any private market assets. Okay, so let's switch gears a little bit. You mentioned this briefly, and something we've seen grow and has been a really great vehicle to provide access to the private markets is special purpose vehicle. So SPVs. If you think about an evergreen fund, maybe as like the mutual fund of private tech where you're getting diversified access, an SPV is how investors can really get a concentrated bet into a single company. And these vehicles are built with the sole purpose, typically, of buying shares in a single company. So can you talk a little bit about why SPVs have become so important within the private markets, especially when it comes to investment access?
Yeah, absolutely. And so kind of our bread and butter here at EquityZen is leveraging the special purpose vehicle, the SPV. Again, I'm going to do another history lesson, but this one's a bit more recent. So in 2013, we started EquityZen. Goal was bringing private markets to the public and really giving investors access to pre-IPO companies or private companies. From the get-go, we thought that we could have an investor buy shares from a selling shareholder of a company. So let's use a company from back in the day. Let's use Palantir, right? So Palantir is a private company. You had somebody that wanted to sell $50,000 worth of Palantir, somebody that wanted to buy. Great. We would match them. We would bring the trade to the company so the company would know. What we learned was that actually, if you brought 10 of those trades or 20 of those trades to Palantir, all of a sudden they were kind of overwhelmed, right, with how much work they had to do and the administrative burden. And as a private company as well, you have to think about how many shareholders you have. If you have in excess of 2,000 shareholders as a private company, you actually have to start disclosing financials as if you're public. So it's kind of like the worst of both worlds. And so in response, after talking to companies, we said, well, what if we bring those investors into one investment vehicle, an SPV, and that bought shares from one or more selling shareholders so that it was one entry onto your ownership table, your cap table, one transaction you had to deal with. And then if there were any corporate actions you needed to do, you're going public, you need us to sign something, you can go talk to EquityZen who manage the SPV rather than the 20 people behind it. And that was very well received. It also really lowered the minimum investment size that investors could have to get exposure, right? Before we were saying, well, you got to have $50,000 to do this trade. Now we said, well, you can do $5,000 in this vehicle, or we'll get 50 people together and then we can put this together. And that really opened up a lot of doors, right? We offer our SPVs to accredited investors, and that requires having $200,000 in income or $1 million in assets. If the minimum was $100,000 and you have $1 million in assets, most advisors would tell you that's a very concentrated bet you're making on a illiquid instrument. So to be able to bring that down to something that's more right-sized for your overall net worth was something that we're really proud of. And I think one of the reasons why SPVs have really proliferated in the private markets and probably in other asset classes too.
Yeah. And I like to think that EquityZen, we are one of the OGs in the space when it comes to these SPVs. We've done over 51,000 investments via this fund structure, and it's really been a crucial vehicle to provide that access to a broader range of investors, which we're obviously really excited about. In the media, as these structures have grown, you're seeing stories about the dark side of this access, and SPVs are getting a little bit of a bad rap. And can you talk about why that is, and some of the things that investors need to look out for when they're trying to invest in these funds? It's certainly not one size fits all.
Yeah, absolutely. So I like to think about in capital markets and in financial services, the further away you are from the asset or the actual thing you want to buy or sell, the more risk involved, right? And that's because there's probably costs associated and there's lack of clarity on what you may end up owning. So maybe another history lesson, this is getting pretty bad, but
We love it.
another history lesson might be back in the financial crisis in 2008. What got us there was that mortgages were being packaged up and then packaged up again and then sliced up and then syndicated out to investors. And then people were making bets on or against those collateralized debt obligations. And it got really messy, right? And so the messier you make a financial instrument and more complicated, the more likely there is to be a problem. So now let's think about special purpose vehicles and think about private companies. Well, the cleanest way to invest in a company would be kind of what I mentioned earlier. You write a $50,000 check, you buy shares from a selling shareholder of a company. The company says, yep, We now know that you hold these shares. Here's your share certificate. Or you invest as an angel investor in a round, right? I've done this. You put in like a $10,000 check as a part of a company's primary financing. And then I've got this share certificate from the company. All well and good. The problem with SPVs is that you're going into a vehicle that's purporting to hold shares. And sometimes you're going into a vehicle like an SPV that is purporting to hold a piece of another SPV that holds shares. So the further away you are from the actual underlying ownership, the more risks are involved. There's been some GPs, right? Some managers of funds that have acted poorly in trying to make money on the fact that investors really love a couple names and they're actually really hard to access. So one way you could raise a lot of money is you could tell clients that you've access to the two or three hardest to access pre-IPO tech companies at the time, right? And investors say that's great. And then they decide they're not going to do their diligence. And ultimately, you don't own anything. And I think that's a really scary concept. And it's yet another reminder that the devil is in the details. And something that EquityZen prides itself on is the amount of diligence we would perform to make sure that the offerings we make available to our clients actually have done that amount of work to verify underlying ownership. Particularly in the fact that the way we set them up normally is that EquityZen forms its vehicle and that's going to hold the shares. And we could show you basically a line to the title, right? It's kind of when you think about houses, right? You buy a house and you make sure that it has a clean title. You buy a car, it has a clean title. There's a version of that for private companies. And we have spent 12, 13 years really perfecting a process to make sure that we know what we own. So it's just a reminder out there that you should really be asking certain questions of your SPV manager of what they own. For you, I think you wrote a very good article about this. So shameless plug, that should get in front of people. And the other thing I would call out is you should really ask about the fees that are involved, right? There could be a combination of a brokerage fee or sales fee. There could be a management fee that's usually recurring every year. And there could be carried interest, which is basically performance fee on the upside. Now imagine if that's on the first layer that invests in another layer that has its own fees, and you can start to see how things get really expensive and opaque. So it's a pretty long-winded way of saying that there's a lot of homework you should do before you just throw that $50,000 investment into some random manager from California that purports to have access to the company you want.
Due diligence is paramount when it comes to investing in these structures and really understanding the pedigree or expertise that the GP has within this market. A lot of times we see when a market opportunity grows, you have a lot of players run in because they see an opportunity to make money. And that's all well and good, but it's important to look at exactly what you're investing in, who you're investing with to make sure that you're making a smart investment. And I think the fee piece is really important. We've seen structures where the hurdle that you need to clear to even break even on your investment because of the layers and layers of fees becomes quite significant. When you're looking at the price per share that you're investing at for a given company, understanding the implied valuation that relates to. So if the company last raised around at $20 a share with all the fees, are you actually investing at $30 a share? That's a pretty high hurdle you have to get over to break even if there's tremendous growth in the company. So certainly something to look out for. Do you want to talk a little bit about our fees and what we've done to really try to streamline this in a market that can get very layered and complex?
Yeah, absolutely. So on the EquityZen side, now as a part of Morgan Stanley, our fees have been reduced down to what we think is market leading, and where we charge a one-time upfront fee of 2.5% that will actually go down as you invest more. And so we're really proud of that, and we think it's really transparent. There's no recurring ongoing fees for these SPVs. And so that's something that we think reflects where we think the market should go and something that investors should be pretty excited about.
Absolutely. So, we've covered two of these key structures that have really allowed the private markets to grow and really have allowed more investors to access them. And democratization is great, but it definitely comes with the need for education, for due diligence. So if you're an investor who's maybe new to the market, you're choosing between an evergreen fund like an ARC or a specific company SPV, what are the deciding factors? How should investors be thinking about foraying into this asset class as part of a broader diversified portfolio?
I'd say take your time and think about this investment being in the illiquid bucket of your overall asset allocation, right? This shouldn't come in lieu of, public equities that are incredibly liquid or bonds, which are also really liquid. This is a illiquid, risky asset class. Having said that, we do believe it should be a growing part of the portfolio from a construction perspective. Back to my point about Amazon being a $500 million company when it went public. If you want to have the beta exposure to this space, some of these funds can do a good job. We just remind people to do your homework. And the last thing I'd say about, the SPV offerings is if you see one and it seems too good to be true, it probably is, like anything else in life. So please do your homework, be patient. But good luck out there too.
Thanks, Phil. And, touching on the homework part, you're not totally alone in doing that at EquityZen on our platform. We really try to provide our clients with as many resources as possible to help them do that. When you invest via one of our funds, you have access to the cap table of that company so you can understand the liquidation preferences for share classes, what you're actually buying, how that relates to the implied valuation of the company. We put together overviews of these companies. We have a ton of educational information on our blog, as Phil mentioned, blog.equityzen.com. So we encourage you to check that out as you dive into this market and get involved. Phil, thanks for coming. Thanks for being our private market historian and really pulling back the curtain on, this really exciting market that's providing a lot of opportunities for investors, but also unique risks.
Thanks for having me. It was a blast.
So to learn more about pre-IPO investing, you can check out www.equityzen.com/investor. Thanks for joining us.